Welcome to the fourth video blog. In this week I want to touch on the capital markets as the main focus. While the regulatory is also covered from this week's readings, you recall I kind of touched on that from last week, so do sort of keep that in mind. But for capital markets, as I mentioned a couple of times, Greece has been kind of the ongoing rumbling issue, and as you probably heard, it decided that instead of paying the IMF its loan on last Friday, it is going to try and collapse all four of its payments due to the IMF in June to the end of this month. So kind of deferring its payments. And in fact, a third of investors believe that Greece will actually probably exit the euro by May of 2016. Now, there is an interesting kind of ripple effect on the Greek economy at the moment. One that, as people are quite unsure what's going to be happening to the Greek economy and whether the old Greek currency, the drachma, is going to make a return if Greece pulls out of the euro, car sales are increasing again for the 20th month in a row. Car sales have been increasing quite dramatically in Greece. In fact, sales figures for April of this year show that car sales jumped by 47%. The reason is that people being concerned about the money feel that they're better wanting to buy high ticket price items, cars, or could be other high valued items like jewellery, because they're more likely to be a better worthwhile to pay for the money rather than trying to stuff it into the mattress. Because the concern is if they leave it in the banks and Greece pulls out of the euro, then their currency is going to be raided, it's going to be devalued significantly. So cars, the four wheels, seem to be the one way to go forward. And also by buying a car, you're not going to be exposed to the kind of capital controls that you could be experiencing if you had that sort of cash in the bank. For example, the inability to pull it out of the bank, out of the cash machine, or transfer it or from one bank to the other or out of the country. So Greece still going to rumble on then. But actually for the increase in car sales, we also saw this in Russia a few months ago, where there was some significant decline in the markets in Moscow, and when the Western sanctions were biting against there. And there too you saw car sales increasing. So as a political risk analyst, you can start to think, okay, well, if the financial situation is looking sticky, what might be the other sectors that might gain from this? And the final word for Greece is that this is principally not the inability to pay its loans, but the willingness to pay or not on its IMF loans and other obligations it may have. Because it's down to, are you going to take a bailout package, EU is saying, and Greece is saying, no, thank you, not at the moment, we don't agree with it. So even though money's been put on the table, so they can make the payments, they're not signing up to the agreement. Unlikely to be a major issue if things to get slightly worse there. Now, we saw something similar with Russia in 1998, whereby analysts completely oversaw or should I say, failed to see the challenge that the Russian government would decide to pay its own domestic workers with a limited amount of cash it had on hand in the country, as opposed to keeping up its international debt obligations. Investors thought, hey, yeah, Russia's going to keep up with its obligations. It didn't. It decided to prioritize its domestic workers to accede to domestic pressures and to say to IMF, no, thank you, we're going to default on our loan. And that precipitated the banking crisis in Russia in 98. So there's sort of interesting parallels for that. Another kind of parallel extension going across to Cyprus. There were riots in Cyprus back in February of this year outside some of the Greek the Cypriotic banks, who had about 2 years ago imposed a major, what they called, haircut to try and replenish the country's coffers. So we didn't have so much a bailout, we had a bail-in. So the Bank of Cyprus and another bank called Alaki in Cyprus, investors with over 100,000 euros in those accounts were told, well, thank you very much, we're going to take about 40% of your savings in those accounts and move that into our own country's central account because we're short of cash, and in return we'll give you an IOU, give you shares, which will pay you back as and when we see fit and able to do so. Understandably, this has caused a lot of consternation. And this was part of a wider package of which was about almost $14 billion worth in loans given out by the EU and IMF at the time. Now, the reason why the bail-in came into play and not a bigger bailout package was that the vast majority of the accounts in Cyprus was thought to have money not from EU citizens but from Russia. And so therefore it became almost politically unacceptable of why should EU money, or say particularly like from Germany, why should its euros go and bail out banks in Cyprus where a large number of depositors are from Russia, of which some of those proceedings in those banks are probably not from legitimate and moral activities. So those political dynamics came into play as well for that. So Greece is still kind of suffering, and Cyprus is still suffering from the situation, and it's likely it's going to remain a big problem for quite a while. Okay, so that kind of wraps up this week's video blog. Enjoy this week's readings and the discussion board on regulation as well. And I look forward to engaging you on the discussion board over the next few days. Okay, cheers.